Welcome to Daily Drive for Tuesday, April 28th, 2026. I'm Callan Walker in Las Vegas. Today on the show, GM posts lower earnings but raises its full-year forecast. Chinese automakers plan to triple overseas production, and failed EV truck startup Bollinger heads to the auction block. Plus, WideWhale CEO Kyler Owens talks about why so many top dealer groups are generating bait-and-switch complaints.
The pricing negativity showing up could also very much be an early warning signal of, hey, yeah, the customer expected this price, and then all of a sudden there were different pricing challenges.
Let's run through all the news you need to know to keep up in the auto industry. General Motors posted a 5.7% drop in first quarter net income, down to $2.63 billion. That's as it grapples with tariffs and a pile of supplier bills. Those parts maker claims stem from electric vehicle demand that never quite materialized. GM shelled out about $2.2 billion in cash to settle those disputes. But here's the twist. GM actually raised its full-year forecast by $500 million. The reason? It expects to get tariff refunds after the Supreme Court ruled that many Trump-era duties are unconstitutional. CEO Mary Barra says performance beat expectations, despite what she calls a, quote, very dynamic environment. We'll have more on this in a minute with our own John Irwin. Chinese automakers are going global in a big way. They plan to nearly triple their overseas production to 3.4 million vehicles by 2030. Why the push? They're trying to escape brutal competition back home. Vehicle prices in China have dropped off by a fifth over the past 2 years. That's according to Dan Hirsch of strategy consultants AlixPartners. Europe and Latin America are the main targets, with at least 8 major partnerships or factories already underway in Europe. Those will help Chinese brands avoid steep EU tariffs on electric vehicle imports. And failed electric truck startup Bollinger Motors is headed to the auction block. That's after suppliers sued over unpaid bills. The company's manufacturing equipment will be sold online May 13th. That includes 20 B4 trucks themselves, along with battery testing systems and shop equipment. Michigan's Labor Department is investigating unpaid wages, and the state wants back about $1 million in incentive money it gave the startup. And those are today's headlines. You can find more details on all those stories at autonews.com. Here to talk more about GM's earnings is our own John Irwin, who covers the Detroit automaker and its brands for us at Automotive News. John, welcome back to Daily Drive.
Thanks for having me back.
All right, John. So GM raised its forecast despite lower earnings this quarter. What's driving that optimism?
A lot of it is driven by, well, first of all, the tariff refunds that they're expecting from over the course of the year. Like we've talked about before, the Supreme Court back in February ruled a lot of the Trump administration's tariffs to be unconstitutional. The refund process just opened up this month in the past several days. And GM, like thousands of other companies, is looking for refunds for the tariffs that they paid that have been ruled illegal since then. They're expecting about $500 million. When exactly that money will come in is sort of still up in the air, just as the application process still plays out and as the administration sort of expands that. But that was a big driver. We've seen the GM expects its tariff bill to decrease by about $500 million over the course of the year because of that. So that was a big driver. And in addition to that, they're feeling pretty good about where they're at in terms of their profit margins. I mean, in North America, in the first quarter, they had about a 10% margin, which was targeting 8 to 10% for the company as a whole. So they were very happy with that figure. Like I said, net earnings are down for the quarter, but they're feeling good about their adjusted earnings before interest and taxes, which were up pretty significantly from a year before. So GM is feeling pretty good about its quarter. That said, it did flag a few things in the long run, specifically related to commodity costs increasing because of the Iran war. It's one of the reasons why, despite them feeling pretty good about where they're at, not really having any major doubts about where the market's headed and that sort of thing, beyond just that $500 million in tariffs, they're not really adjusting their outlook even further, mostly because they're not really sure where those commodity prices are going to end up, just because there's so much uncertainty about, when the war, how long it'll continue, what the long-term impacts will be. They're sort of in wait and see mode there. So, GM is sort of they're feeling optimistic. That I think they're seeing a lot of upside if the war were to wrap up, pretty quickly, and maybe the Strait of Hormuz were to reopen somewhat quickly. That they would see a lot of upside there, and maybe at that point you'd see further increases. But as of right now, they're just kind of clinging on to that $500 million in tariff refunds as a way to justify increasing their outlook for the year.
Now, what are other big takeaways from this earnings report?
Yeah, there are a few that kind of stood out to me. First of all, GM, over the past couple quarters, like we've seen with other automakers, they've highlighted some of the costs, billions of dollars that they've had to write down because of the EV slowdown, lower than expected EV sales, retooling some of their factories to go back to making ICE vehicles and that sort of thing. GM kind of highlighted that last quarter. This quarter, they highlighted about $1 billion in hit that they took to their earnings, and then about $2.2 billion that they spent in cash to adjust for that. Largely, this time wasn't really about their factories, but more about settling claims that suppliers have put in. I know we've talked in the past about suppliers and how they've made a lot of investments themselves in recent years to supply EVs, and as those volumes haven't been there, they're not getting the returns on investment that they were expecting, and they've gone back to their automaker customers to try to get some of those costs back. And GM, like I said, they paid about $2.2 billion in cash in this quarter just related to that, and that's about 90%, they said, of the amount of claims that they've had so far. They've settled those. They're expecting to settle most of the rest in the second quarter. There's some long-term things related to battery materials sourcing and that sort of thing that might take longer, but they're hoping to get all that wrapped up as soon as possible so that they can sort of turn their attention to the future, as Paul Jacobson said on the call today. And then beyond that, GM in recent weeks has really tried to drive home to its investors that it sees subscriptions to OnStar and Super Cruise being a big driver of revenue for it in the future, pointing to big jumps in subscriptions and revenue that they're seeing from OnStar subscriptions and Super Cruise. And again, this quarter was no different, seeing pretty sizable leaps in both subscription numbers and the amount of revenue that they're seeing both right now and kind of deferred into the future. And we've heard a lot about that in recent years, automakers eyeing subscription revenue, and maybe hasn't been fully realized as quickly as a lot of companies were suggesting a few years ago. But GM is optimistic its approach, where you get an OnStar subscription or Super Cruise subscription for years up front, and then at that point, once that ends, you can renew. They think their approach is one that'll work, and they're seeing that with renewal rates about where they were hoping for, and would suggest that there's maybe some meaningful revenue there in the future as more cars are sold with those technologies. So it's an interesting quarter for GM, sort of a lot of different trends that we've seen in the industry, how GM's adapting to them, and they're feeling decent about where they're at.
Perfect. John, thank you so much for joining me.
Thanks so much.
The FTC has been cracking down on dealership advertising practices, sending warning letters to 97 dealerships about pricing violations. New data from WideWhale shows that bait and switch complaints are a widespread problem, even among the industry's top-performing dealer groups. Kyler Owens is CEO of WideWhale. He spoke with Automotive News senior retail editor Dan Shine about the company's analysis of customer reviews and what dealerships can do to address these compliance issues.
Kyler, thanks so much for joining me on Daily Drive.
Yeah, Dan, thanks for having me back. I really enjoyed our last conversation, and looking forward to this one for sure.
So FTC dealerships, the 97 letters that the FTC sent out to some of these dealerships saying that their pricing and advertising pricing was wrong, and that they were put on warning about this. Yep. Led to a lot of discussions, a lot of questions from dealers. FTC held a webinar for dealers, didn't go so well. Held the second one on Friday, went a little bit better, but I think there's still a lot of questions. You guys crunched some numbers at WideWhale, looking at different dealer reviews from customers, and found that there's a lot of bait and switch complaints, these kind of pricing complaints that come up often. First of all, tell me how you the methodology behind how you came up with these figures.
Yeah, absolutely. So we've been tracking review data across every franchise dealer for the last 3.5 years. So we maintain a proprietary database, data engine that monitors 100% of those reviews as they come in and goes through an analysis of those across those 18,000 plus locations. And, we've built a refined custom automotive specific sentiment model where we're really listening to what customers are saying and what kind of feedback they're giving. And its reviews are fantastic because it's basically consumers telling other consumers about their experience and what to watch out for. And so we generated a specific report. We aggregate all the top level sentiment data for the dealers that we work with. And in this case, we really focused on the top 150 dealer groups that are out there. And we, of course, segment all of those versus the national industry benchmarks. And that allows us really to understand, in this case, specifically on a few different vectors, what customers are saying about their experience, what they're upset about, what kind of perception they have of the service that they've received, or what kind of surprises they're showing up when they walk into a dealership that they're not expecting.
So one of the key findings you came up with at Wide Whale, of the top 150 dealer groups, 41% generate a higher rate of bait and switch complaints than the national benchmark. What constitutes bait and switch? I think people kind of know what bait and switch is, but how do you kind of determine that?
Yeah, so we obviously use AI. That's a lot of data. So we use AI to identify bait and switch by analyzing the context of negative reviews. So we focus on negative reviews where people are either have a low score or have said negative things about the dealership. In this case, it's negative reviews specific to deceptive pricing or inventory patterns. It's not like keyword matching. The model recognizes descriptions of common friction points. Some examples of that are just like online to over the phone price quotes that are not honored when they show up in the dealership, or inclusion of mandatory undisclosed hidden fees or add-ons like protection packages, line items that they were not described before during the desking process. And then advertising specific inventory that's not available, that comes up, and we find that in reviews where customers find it unavailable when they show up, or it's significantly more expensive or a different vehicle than what was advertised in the store.
And you also talked, throwing some of these numbers out there, about a national benchmark. Is that just kind of a benchmark that you set amongst the 18,000 dealerships?
So when we do that analysis, we're able to, because we have every dealership in the United States, we're able to benchmark what's the standard. And that's really important to understand how you're doing versus your competitors. I talk about this a lot, like a 400 batting average doesn't sound that good unless you're seeing how poorly some of the other hitters are doing, right? And so in this case, the national benchmarks and the categories we used for this study were price and cost negativity, and that benchmark across the U.S. is 19.4% of the negative reviews reference negativity about price or cost. The benchmark for bait and switch is obviously lower, which is a good sign, but 2.4% of the negative reviews that come in reference bait and switch or imply bait and switch. 11.6% reference honesty as a negative faction of what they're talking about. And obviously that ties into they've said one thing and then did another. And then we also did analysis on the financing department, and the number of times that a negative review ties into that or references that is 7.6%.
So you also talk, but of the top 150, again, dealer groups that you kind of studied, 45% were above the baseline for price cost friction. So again, that is what a customer, I guess, expects the cost to be, or the price to be, and it turns out to not be that. I guess that's how you define that friction.
Yeah, I mean, it's probably a mix because of those two around. Some are just upset with higher prices, which we know is an industry event that's happening. But in a lot of those, and that's why we tap into bait and switch and honesty and specifics of those to get some of those other categories. But that the pricing negativity showing up could also very much be an early warning signal of, hey, yeah, the customer expected this price, and then all of a sudden there were different pricing challenges. So I think is like the ethos of what the FTC is doing, is trying to make sure that they're consistent and very easy to understand prices for consumers. That negative benchmark that we analyzed really taps into that sentiment. Now, the things that they've gone through and they've identified are a little bit different than that, but they're certainly captured within that.
So I guess, the bottom line, as it were, is that dealerships, they're still, even if you're a top performing dealership, I mean, it's not these are not just the smaller single roof top. These are top 150 groups that are having these issues. What takeaway should they have? And again, is this just monitoring their own reviews to see if there are issues, and then checking out their processes and trying to fix those?
100%. Yeah. So if you think about it, and reviews have been escalating when you think about digital natives and the way they communicate in the marketplace, that chunk is definitely growing. We saw 25% year-over-year growth in the amount of reviews written across these franchise dealers. And we're seeing almost 500,000 reviews monthly coming in for dealerships. And so if you think about the analysis of that, I think a lot of dealers have really focused on, hey, I want to get a high star rating, and I want my customers to say nice things about me, and we'll try to grab those and highlight those. The reality is, this is an opportunity to really listen to them and understand where friction sits, and apply that to your business. And when they're talking about these things with compliance restrictions and things around that, it becomes even more important than it is. There's a lot of operational data they can improve their business on, but in this case, these are things that regulators are looking at. These are things that it's important to keep a tight eye on and respond to quickly, because these are the folks that are highlighting. I'll also add, when you think about dealership searches and people looking for these things, it shows up on agentic search for sure. And with Google's agentic search, it's showing up a lot as well. As this sentiment is visible for anybody to search and find out.
A good reminder for dealers to listen to their customers, pay attention to what they're saying.
Yep.
And if they're saying some bad things, try and fix it.
100%.
Kyler, great to have you on. Appreciate you jumping on real quick with us and talking about this kind of top issue, and have a great rest of your day.
Yeah, Dan, I appreciate it. Great to connect again.
Kyler Owens spoke with Automotive News Senior Retail Editor Dan Shine. That's Daily Drive for today. I'm Kellen Walker. Thanks to Automotive News Executive Producer Jake Neer, as well as our own John Irwin for his reporting for today's podcast. We also had reporting from Lois Jones and Kurt Nagel of our sibling publications, Automotive News Europe and Crane's Detroit Business. You can get the latest news on dealership compliance, earnings results, and everything happening in the auto industry at autonews.com. Come back tomorrow for an interview with Sebastian Mackinson, CEO of BMW North America.
You have technology openness, as we like to call it, where the customer chooses, I want this drivetrain, I want that drivetrain, or I want that drivetrain. And that's what we really think is the right approach, because it means that you don't have to make a compromise linked to your choice of drivetrain.
We'd love to hear from you. Let us know what you think of the show and the topics we covered today. Send us an email at dailydrive@autonews.com or leave us a voicemail at 313-444-2774. And if you enjoyed the podcast, remember to like, leave a review, and subscribe so you never miss an episode.